What if I told you mortgage rates could drop to 5.5% in 2026 and it has nothing to do with the recession? That might sound far-fetched, especially when Fannie Mae is predicting 6% and the Mortgage Bankers Association is even higher at 6.4%. But here's what's strange. Treasury yields are falling, rent growth is negative, and AI is displacing white-collar workers faster than any technology in history. In the next 8 minutes, I'm going to show you exactly why these four forces are converging right now to create a legitimate path to 5.5% mortgage rates by late 2026. Force number one, the revenue revolution. When the government needs to borrow money, it sells bonds. More bonds equals higher yields equals higher mortgage rates. But tariff revenue is generating approximately $2 to $250 billion annually in new government income. That's $2 to $250 billion in fewer bonds they have to sell each year. But wait, don't we still have a huge deficit? Yes, we do, unfortunately. 1.8 to 2 trillion annually. But consider this. The Genius Act passed in July of this year requires stablecoin companies to hold U.S. Treasury bonds as reserves. $1 of stablecoin equals $1 of Treasury bonds they must buy. In just 4 months after the law passed, stablecoin issuers purchased $109 billion in Treasuries, and the stablecoin market has grown to over $300 billion. Treasury Secretary Bessent projects this could reach $3 trillion in 2030. At the current pace of growth, we're looking at $300 to $500 billion in new Treasury demand just through 2026, and potentially much more if adoption accelerates. So here's what's happening. The U.S. still borrows $1.8 to $2 trillion annually, but tariff revenue reduces that by $2 to $250 billion, while stablecoin demand creates hundreds of billions in legally mandated buyers. So supply down, demand up, Treasury yields fall. And mortgage rates are tied directly to Treasury yields. Now, there's one caveat. If tariffs end up spiking consumer prices and driving inflation higher, the Fed would be stuck and they couldn't cut rates. But that doesn't seem to be happening, at least not yet. Costs are being shared across producers, importers, and retailers. And China is installing industrial robots at 9 times the U.S. rate to absorb costs through automation instead of price increases. So far, tariff revenue is reducing bond supply without spiking inflation, which means the Fed has room to cut. Force number two, the productivity boom. For the first time in over 30 years, college graduates now have higher unemployment than the general population. Recent college grad unemployment hit 5.3% in 2025, while overall U.S. unemployment is 4%. This is a complete reversal. Even during the 2008 financial crisis, college grads had lower unemployment than everyone else. And this is happening in exactly the jobs AI can replicate. A coder can now write code 10 times faster using AI tools. Analysts generate reports in minutes that used to take days. Entry-level business roles, entire job functions are being automated. Here's why this matters for mortgage rates. The Fed's biggest fear is wage inflation in the service sector. That's 70% of the economy. Service inflation is sticky because it's driven by wages, not supply chains. But if AI is suppressing white-collar wage growth, which these unemployment numbers prove, the Fed can cut rates without triggering a wage price spiral. Force number three, the rent lag. Here's the big deflationary force that's already locked in. Market rents have been in decline for 26 consecutive months, over 2 full years of falling prices. The median rent is down 2.1% year over year and sitting 2.7% below the 2022 peak. And this pressure isn't letting up. With over 2 million people having left the country through voluntary departures and deportations in 2025, rental demand continues to soften. It's basic supply and demand. Fewer people needing housing means continued downward pressure on rents. But here's the disconnect. Official CPI shelter inflation is still sitting at 4% year over year as of April 2025. So why the massive gap? Because the way the government measures rent inflation, they don't track what new tenants are paying. They track what existing tenants are paying under old leases. And because of lease terms and renewal cycles, that data lags market rents by 12 to 18 months. So the math is pretty simple. The falling market rents we're seeing right now in 2025 won't show up in official inflation reports until late 2026. And when CPI shelter inflation drops from 4% to near zero or even negative in 2026, that's 33% of the entire inflation index collapsing. And here's why that matters for your mortgage. Lower inflation means lower inflation expectations. Bond investors price the 10-year Treasury based on where they think inflation is going. And when shelter, the stickiest part of inflation, finally shows up as falling in the data, Treasury yields drop. And as you know, mortgage rates are tied directly to Treasury yields. Force number 4, the policy shift, Hassett and mortgage spreads. May 2026, Jerome Powell's term ends. Prediction markets show an 85% probability his replacement will be Kevin Hassett, and Trump has said he knows who he's going to pick. Hassett publicly stated he would cut rates right now if he were in charge. And more importantly, he explicitly said one of the administration's top goals is to reduce mortgage and auto loan interest rates. He said this on CNBC last week. The tool that matters is mortgage-backed security purchases. When the Fed buys MBS, which they did for over a decade after 2008, it compresses the spread between Treasury yields and mortgage rates. The current spread is 2.2%, and historically it's been 1.7%. So if the 10-year Treasury stays at 4%, today's 2.2% spread gives us a 6.2% mortgage rate. A 1.7% spread gives us a 5.7% mortgage rate. Same Treasury yield, 0.5% difference just from the spread compression. And here's the political reality. Housing affordability is the defining issue for young voters, and Republicans control both chambers. They need results before the midterms. So we could see spread compression starting in Q2 2026, not from actual Fed buying, but from the expectation of it. That's the Hassett put. So what should you do? What does this all mean for you? If you're the type that likes to time the market, my advice is simple. Wait. Not forever, not for years, but if you can hold off for another 9 to 12 months, you're likely looking at mortgage rates around 5.5%, nearly a full percentage point lower than today's 6.3%. Tariff revenue is real. AI productivity displacement is real. Rent deflation is locked in, and the political pressure to lower housing costs is enormous. These aren't theories, these are forces already in motion. The question isn't if they'll push rates down, it's when. This year, home prices have been rising 1 to 2% annually, not racing away from you. So do the math. If you wait until late 2026 and rates drop to 5.5%, you're looking at a lower monthly payment even if housing prices go up 1 to 2%. And over the time you own the home, the rate difference more than offsets any price appreciation. Now, if you find the right house at a great price, buy it. Don't overthink it. Life happens. You need to live somewhere. But if you're feeling pressured, if you're on the fence, you can wait. And if you do buy now, just watch mortgage rates. When they drop 1% lower than what you locked in, and if you're staying in the home for at least 5 years more, refinance. It's that simple. So that's the case for 5.5% mortgage rates by late 2026. Now you know what to watch for and when to make your move. If you enjoyed this video, here's what I want from you. First, hit the subscribe button. I release new videos like this every Friday at 5 p.m. Second, drop a comment. Tell me, what do you think mortgage rates will be by the end of 2026? Are you buying now or are you waiting? And if you're waiting, what rate would make you pull the trigger? And if you got questions, real questions, not just should I buy, reach out. There's a link in the description. Thanks for watching, and I'll see you next Friday at 5 p.m.